The Buffett approach to valuing stocks. Focusing on return on capital may be the key to investment success. Starting at the beginning. Let's review a quick summary of the qualitative and quantitative parts of Buffett's decision-making process as noted by Robert G. Hagstrom before we get our hands dirty with the valuation aspects of the investment choice. This roadmap, which is made up of market, financial, management, and business principles, aids us in navigating the rough waters of Wall Street. Investment business principles. Is the business simple and understandable? Does the company have a long history of successful operations? Do the company's long-term prospects look promising? Is management rational? Does management make sense? Are managers open and honest with the stockholders? Financial. How much return on equity, ROE, is there? Avoid focusing solely on earnings per share, EPS. What percentage of the business makes a profit? For every dollar kept, does the company generate $1 in market value? Market. What is the business's worth? Can a sizable discount be obtained on the company's purchase? The market tenets portion of the valuation exercise is covered in this piece, although it only applies if the company in question satisfies the other qualitative and quantitative criteria. Note that Buffett emphasizes completing your own research, which requires more than just gathering historical accounting data and inserting it into the model being given. Buffett has frequently stated that reading, including books, newspapers, journals, and the annual reports of the subject firm and its rivals, constitutes a significant portion of his investment homework. A comprehensive reading of annual reports is very helpful in answering queries about business and management principles. Numerous numbers, limited time. Now that you've read the yearly reports, you've probably discovered more numbers than you can possibly process. Which are crucial? Which are necessary? Which may be omitted? In actuality, the entirety of the information disclosed in these disclosures may be helpful for a number of reasons. Using the following accounting data: revenue, net income, the book value of shareholder equity, earnings per share, EPS, dividends per share, and the total number of outstanding shares, Buffett tries to calculate the expected return on equity capital, ROE, and the growth rate of book value, BV, per share. P/E ratios are also helpful, but they are not frequently encountered in yearly reports. The Value Line Investment Survey and Standard & Poor's stock reports are two of the top sources for this information. Both have all the information required for the valuation process. Although they do need subscriptions, most public and academic libraries offer free access to them. Calculating the expected return on an investment. However, this technique also works for shorter investment horizons. In the end, we will estimate the book value of shareholder equity 10 years in the future, and we will use that figure as the basis for computing a projected rate of return on a company's stock. According to reports, Buffett uses a 15% threshold rate of return. Anything less is deemed unacceptable. We will go through a number of procedures to get there that are thoroughly detailed in books written by Buffett's former daughter-in-law, Mary Buffett. Below is a summary of these processes along with some modifications to strengthen the analysis. Due to Buffett's 2008 investment of more than $100 million in the diversified power management company, Eaton Corporation, ETN, we will utilize it as our example company. Step 1: Gather the raw data and create the basic spreadsheet. The historical accounting data for ETN used in the accompanying valuation model includes the variables that Mary Buffett uses in her Buffettology books. Each variable's annual and overall growth rates are computed. As a sanity check, the remaining data are utilized. For instance, if EPS growth outpaces that of revenues and net income, management is probably driving EPS growth through share repurchases. ETN's average annual EPS growth is higher than its revenue growth, which is 8.87%, but it is not higher than the growth rate of its net income, 12.25%. By analyzing the cumulative growth rate in shares outstanding over the previous 10 years, it is evident that ETN has been issuing shares, 15.06%. The correlation between revenue and net income growth is another one to watch. For ETN, net income has exceeded sales by more than 85% over a 10-year period, or about 3.38% per year on average. This partnership has little chance of lasting. Cost-cutting has a limit, hence the growth rates of these two variables should eventually converge. Buffett also keeps an eye on the correlation between the growth rates of EPS and shareholder equity. Because the additional return on equity is diminishing if EPS growth is not faster than shareholder equity growth, the company is probably not a good investment candidate. These growth rates are nearly comparable when using ETN. Step 2. Calculate the book yield. EPS is simply divided by book value per share to calculate book yield. To compute the traditional ROE, you may instead divide net income by total shareholder equity. Rounding in the accounting data and per share amounts is probably to blame for the minor discrepancies seen in some years. Additionally, you can determine the 10-year median ratios for all three variables as well as the dividend payment ratio, dividends per share divided by EPS. Step 3. Estimate the future book value. The growth rate in BV is then calculated by dividing book yield by the retention rate from the most recent year. In our case, the 2008 book yield is 17.8%, and the retention ratio, which is determined by subtracting the dividend payment ratio from 1, is 70.78%. Our calculated book value growth rate is therefore 0.1261 or 12.61%. The most recent year's book value, 2008, is $38.30. For the following 10 years, this will serve as the basic value for estimating BV annually. The average BV growth rate over the last 10 years can be calculated and used as the growth rate for the upcoming 10 years as an alternative to the current strategy. In this instance, 10.32% is what we estimate the growth rate to be. Step 4. Estimate EPS over the investment horizon. The formula we use to estimate our annual EPS is simple: multiply book yield by BV. For instance, the expected EPS for 2009 is $7.69 per share. The approach also yields a $22.40 2018 EPS forecast, which is utilized to forecast the stock price in the future. The 2009 EPS projection can be compared to the current $3.40 per share analyst consensus forecast for benchmarking and comparative reasons. It's vital to keep in mind that we are smoothing the earnings stream for estimating even if our near-term forecast is more than twice as high as the current estimate. With this model, we hope to accurately predict cumulative earnings and EPS 10 years in the future, not only the earnings for the current year. Step 5. Estimate future stock price. You need to calculate the product of our 2018 EPS estimate and the anticipated P/E ratio in order to forecast the future stock price in 10 years. It is recommended that the average yearly P/E for the last 10 years be used to establish the P/E estimate. But there is a step in the procedure that I would change. The median historical is preferred P/E to the average historical P/E because the extreme values in our sample of historical P/E ratios will have a greater impact on the average historical P/E estimate than the median historical P/E estimate. The average P/E ratio will be larger than the median P/E ratio, for instance, if the P/E ratio in a recent year was unusually high. Additionally, you must reduce the impact of high values and compounding biases because we are attempting to estimate the P/E 10 years in the future. The median P/E ratio for the year is 16, and the median P/E ratio for the low P/ES is 11. The calculation of the median for the entire sample, which is 13.5. In this instance, the average P/E of 15.1 is noticeably close to the median. Also keep in mind that we will base our valuation in Step 6 on both the low and high values of the P/E sample. Future value anticipated for ETN share can be computed into 4 possible prices for each of our P/E ratio hypotheses. Expected stock prices for low, average, median, and high P/E ratio predictions are $111.99, $338.22, $302.39, and $761.56, respectively. Step 6. Calculate the expected return. Calculating the anticipated yearly dividends over a 10-year investment horizon is the first stage in our valuation approach. The subject stock's current price must be included in the model. You should choose a share price of $65, which roughly represents the average price Berkshire Hathaway paid when acquiring the stock in late 2008. The outcomes of our valuation exercise are provided by the model. The predicted annual rate of return on investment ranges from 9.4 to 27.2%, with an estimated return of roughly 17.9%, depending on our projection for the P/E ratio 10 years from now. Step 7. Interpret the results. According to our preliminary research, Buffett's acquisition of ETN at an average price of $65 satisfies the 15% expected return requirement in our base case, where we assumed median BV growth and average P/E ratios. According to our findings, the growth rate in book equity only needs to be 10% for the investment to yield a 15% return on investment when using an average P/E estimate of 15. On the other hand, it appears that achieving a 15% return on investment becomes far less possible if the growth rate drops below 10%. We can contrast our profit projections with the analysts that track ETN as a sanity check. Analysts' consensus for 2009 EPS at the time of writing was $3.40, which is less than half of the estimated 2009 EPS of $7.69. However, it is crucial to keep in mind that we are making a forecast that is meant to be reasonably accurate over a 10-year horizon, not only for next year, before we discard the methodology. This means that the EPS estimate in year 10 of the estimating period must be somewhat close to the actual profits in that time, and the anticipated cumulative earnings for the 10-year period should be near to the actual cumulative earnings. How much of an estimating bias we now have for these two values is impossible to quantify. We may test the mismatch after noting the discrepancy in earnings estimates by recalibrating the model to begin with the 2009 EPS estimate of $3.40. Our model indicates that there is a slim likelihood of achieving a 15% return on investment while maintaining the same growth and payment assumptions. The underlying hypotheses predict an estimated return on investment of 8%. The situation improves, however, once we take into account that ETN is currently trading at a significant discount to Berkshire's average purchase price of $65, about $40 per share, and we update the model appropriately. Currently, the model predicts a return of 14 to 15%, which is exactly at the acceptable level. Therefore, the current market price delivers a return that is nearly equal to the 15% that a Buffett-type investor would be seeking if one recalibrates the earnings stream based on analysts' expectations for 2009 EPS if they are unhappy with the model. Conclusion. In this post, a rather straightforward valuation methodology is described. The expected return on shareholder capital of a company serves as the foundation for the valuation and rate of return calculations. Finding businesses that outperform their competitors and have historically generated strong returns on shareholder capital while maintaining competitive advantages is your best option for finding profitable companies. Once you have identified these companies, you may use this valuation calculator to establish whether the market is offering the company's shares at a low enough price for you to achieve your desired rate of return. Keep in mind that the model's value and return rates are only as good as the inputs. You can lessen the likelihood of input biases, which will therefore have an impact on your valuation estimates, by completing some research and analysis. As a result, you should be able to make more confident financial choices. This will help you to control your emotions, which may be very strong when the market is volatile. You can still invest with professionals who employ a similar procedure if you decide that this method is not for you. The Sequoia Fund, Fairholme Fund, Longleaf Partners Funds, and Wasatch Funds, among others, are all deep value investors, and they are frequently mentioned when talking about people who can successfully implement this investing strategy. Berkshire Hathaway is another deep value investor. Please subscribe for investing videos.